I'll tell you a little story about these lessons. So when I was on Wall Street, the first secret I learned, I was working on a trading desk. You know, you ever seen the old movies, the trading desks? You have like long desks and they got a turret, phone turrets. And back then, you know, you pick up the phone, you walk to they had fax machines. It was like ancient times. Anyway, we'd all be on this desk together and it was a lot of action, but we weren't trading equities. We were selling bank loans. Basically, the bank, Credit Suisse, would say, we'll loan hundreds of millions of dollars to a company. And they were companies that were not investment grade. This is where the first lesson comes in. They used to be called junk bonds. How many heard the word junk bonds? Right, so junk bonds meant that they weren't the best quality companies. And a guy named Michael Milken made those famous in the late 70s and 80s. And that's actually where Howard Marks worked with him at one point. And what happened was that we were selling bank loans, and they were called high yield at that time. They changed the name. And it used to be called junk. It meant the companies were not the best credit qualities, but you would charge more interest rate to these companies to borrow money. Today, you see that in private credit, things like this. They might go to a private credit, pay a little bit higher, but it's easier to get the loan done. They don't go to a traditional bank. But the lesson I learned was they took something that was called junk for years. It was called junk bonds. Then Michael Milken ended up going to jail. He did insider trading. And guess what? They said, oh, junk doesn't sound too good, and it's associated with Michael Milken, who's now a criminal. And they changed the name to high yield. High yield. How does that sound, high yield? Doesn't that sound much nicer than junk? How many of you want some high yield investments? Or do you want some junk investments? Which one do you prefer? And so that, along with one other thing I realized, that was an observation I made while I was sitting there, and I kind of knew the history. And then the other piece that I had an epiphany about was back in the 80s when I was growing up, how many heard these terms, corporate raiders, leverage buyouts? Do you remember? Carl Icahn, he was a corporate raider. He took down, what was it, Texaco or something, right? Hostile takeovers, right? That's what they called it back then. You know what they call it today? Anybody? It's called private equity. It's called private equity. They changed the name, and it sounds so much nicer. So the first lesson, my friends, is Wall Street will change the name on you, and they'll sell it. So then from there, what happened was, what I realized was we were on this trading desk. So what would happen is the bank would commit money. They'd say, we'll loan $800 million, back when that was a lot of money. You know, nowadays that's nothing. They talk about billions and trillions. But back then, that was considered a lot of money. And they would lend the money, and then they would send it to us on the syndicated finance desk. And they say, go sell. We don't want $800 million on our books. So we do a syndication. How many of you have done a real estate syndication, or you know what that is? You're syndicating. So they basically say, let's get all the banks together. We'll have a meeting. And when we make the loan, you'll take 20 million. Bank A will take 50. So we'd sell the loan. You understand? So we'd syndicate it. So we didn't take all the risk. And then what would happen is one day we'd have loans, and the risk management guy would come around, and he'd be like, you got to get these loans off our book. They didn't like them anymore. So we'd keep our share. We'd keep maybe 50 million or 100 of that 800, and we'd sold the rest off. And then they say, you know what? We need to get this off our books. They don't like it. Something's going on with the company. And so they'd send it to us, and we had a secondary loan trader on the desk. Now, at the time, that was a new business in the late 1990s. He was a young guy, and he was a very good talker, really good talker. So he'd get on the phone, and he'd start banging the phones and trying to get rid of these pieces. So he would get rid of a piece. And I remember one time he sold this loan off, And it was basically a dog, I hate the word the dog because I love dogs, but it was not a good loan. It was not a good loan. He sold it to the bank. So guess what happened? Anybody want to guess? Eventually, I don't know, 6 months later, they called up, not happy, the bank that bought it, because they stopped paying the loan. They stopped paying. And so now it was in a workout situation, they call it. But meanwhile, we had dumped this loan on the guy. And back then, they didn't call up yelling or screaming. They were just like, it was all very friendly. Everybody was very well, put together. And so they would call the guy, I'll call him Chuck. I'm not going to tell his real name. I'll call him Chuck. But Chuck said, then I saw the meetings happen. Chuck would go to the head of the desk and be like, look, this guy's pissed off. We loan him, we gave him this loan. And so basically they said, all right, tell him we're going to give him a piece of something else that's going to be good for him. And so he called the other guy back, blah, blah, blah. And everything got sorted. And in that moment, I realized the secret too, which is, this is how Wall Street operates, folks, because they had to just keep it flowing. They had to keep it flowing. So that was lesson two. Lesson two I learned when I saw Chuck. We kind of skate his way out of this bad situation. And it also actually brought me to lesson three pretty quickly, because I realized this other truth, which you have to be really careful with, folks. And how does that affect you? Because what happened in the dot-com bubble? How many remember dot-com? So they sold all these internet companies. Why? People wanted internet companies. And some of them had no revenue or nothing, and they went to zero. And a few made it, as you know, and then a lot more came out later after the crash in 2000. But what's happening today? People love quantum computing. They want nuclear. They want AI. You have all these companies, especially in quantum and nuclear, they have no revenues, nothing. Now, maybe they will once they get to that point, but they trade at high valuations. But the bottom line is, I'll give you another one, electric vehicles. A few years ago, electric vehicles, Tesla, clearly the best of that breed in the US. And then they came out with Lucid and Fisker and Rivian, and they sold to the market. And some of them are a little bit, Fisker went to zero. Several went to zero. Let's just say that. But the market wanted EVs. The customers wanted to get in on the action. You have to just realize that's going on all the time. So when you see stuff coming out, just because it's offered, just because it's a public stock, doesn't mean that that's necessarily good in your long-term interest. You wanted it, they'll sell it, period. Just got to be realistic about that, folks. Anyway, I learned that lesson early. And I hope you will learn it now as well. And then, so what happened then? And I'll just bring that around to something, because I hate to talk about crypto, but whether it goes up or down, the bottom line is you have, like when you see somebody like Jamie Dimon, he goes on TV and he says it's a fraud and it's a pet rock, a digital pet rock. But then they go, well, JP Morgan will allow you to hold Bitcoin. You say, he's just lying. He loves it. He's actually lying. I heard somebody say that. He's lying to talk the price down, which I think is not accurate. But think about his position. Let's say he's got all these private wealth clients and they want Bitcoin. Now, you're not going to offer it to hold it because they wouldn't custody it before. None of the banks would allow you to custody to have it on the firm's books. They wouldn't allow it. But now, if I got a lot of clients who want it, if I don't offer it to them, what's going to happen? They're going to go to the next bank and they're going to shop around. So even though I hate it, he says he hates it. He thinks it's awful, whatever. And but and then he still offers it. So it's a contradiction. So don't get caught up in that. And so that's, just an example of how that happens. But it happens a lot, folks. And so just be aware. They'll sell it to you if you want it. So don't think that it means anything. So now as time went on at Credit Suisse, by the way, it was a great place. It was a great place. I learned a lot. But one year at the Christmas party, they played a game, and it was a funny game. One of the guys put it together. It was called "Who Wants to Be a Billionaire?" It was a take on Who Wants to Be a Millionaire, and it was just a joke. And basically, they had like a presentation book, and each page would say things about one person in the department. It was like a joke. This person's, whatever. And you would have to guess. The game was you'd have to guess who the person was. So they came to me, and I was a junior guy on the desk. And they said, one of the things they said was, he's a slumlord. Now, at the time, I had just bought a couple properties in Queens, New York. So I'm working in Manhattan, big fancy Manhattan, and I'm buying properties out in working class neighborhood in Queens, small apartment buildings. I scraped money together. I wasn't making a lot on the trading desk back then. I was the junior guy there. The guys I worked with were 10 or 15 years older. I'm in my 20s. They're making a lot of money. I'm doing a lot of grunt work, but I learned a lot. Anyway, and they taught me a lot. They taught me how to evaluate businesses and financial statements and things like that. So anyway, they had this thing at the Christmas party, and they said, he's a slumlord. And so that was the joke. The joke was, because what was going on in 1999? The dot-com bubble. This was Christmas 1999 they did this. And that was the height. The markets peaked at March 2000. So it was a few months before the peak, but everybody was getting, and it was really hard for me. That was there's another lesson in there, which I always talk about, but I didn't get caught up in it until the last few months. And I ended up buying one stock, Healthion. I wrote it from 63 to 11. How many remember the details of a painful experience? That was a painful experience for me. 63 to 11. And I had lost a bunch of money. But that's a side lesson. I always talk about that. These other ones was that I realized at that moment, because they would make fun of me. They were nice people. Like, they weren't like being mean to me or something. They were just, needling me a bit, because they were all doing .com stocks, and I'm buying boring old properties in Queens, New York, a very uncool kind of hip place at the time, whatever. Maybe some would consider it. So I was buying those, and they're calling me slumlord and making fun of me. And I realized in that moment, among the other things that were going on, was that because everybody wanted to be in the hot stuff. And I realized in that moment, people want to look good and have a strong desire to move towards what is hot in the moment. They can't bear to miss out. And that's how the bubbles form. So they're all in the .com stuff. By the way, these people are supposedly, they say Wall Street, the smartest guys in the world or whatever. They're supposed to be the smart, but they're just hopping on this bubble like crazy. Like, I would watch every day. Guys would be looking at their accounts. Stocks are going up $10, $20 a day. CMGI, Juniper Networks, Yahoo, eBay. How many remember this? Stocks were going crazy, and they were all in on it. Me, I'm buying properties. Nobody cares about real estate. Literally nobody. It's not like today. Everybody thought it was silly. And guess what that means when everybody doesn't like something and ignored? The prices were good. The prices were good. So that's how I became a contrarian. I've always had a contrarian streak. I get uncomfortable actually when everybody's talking about something like in a really enthusiastic way. That's what made me super uncomfortable with the Bitcoin early on. It's gone up, but I had people say, I would just ask one question: can anything go wrong? And they'd be like, no. And I just know that from every investment, something could go wrong. There's always something that could change your thesis. So I always have a healthy dose of humility when it comes to picking the investments. And I suggest you too.